Circle's recent initial public offering, or IPO, was one for the history books. Shares debuted at $31, only to rocket over 300% in a day, briefly hitting above $100 a share and forcing multiple trading halts along the way. Now though, investors are left wondering if Circle's sky-high valuation actually makes sense, or if it's just another crypto-related frenzy that's sure to fizzle out. Well, today we're taking a closer look at Circle's fundamentals and future growth potential, examining the biggest risks facing the company, and looking to answer the all-important question: is Circle's stock actually worth it, or should you steer clear?
So I can stay clear.
My name is Guy, and this is a video you don't want to miss. Okay, I'll start by saying that nothing in this video is financial advice. It's purely educational content intended to inform you about Circle. Now, before we can properly assess Circle's astronomical valuation, we need to understand exactly how it got here. So, for those unfamiliar, Circle Internet Financial, aka Circle, was founded way back in 2013 by Jeremy Allaire and Sean Neville, two seasoned entrepreneurs with a track record of building successful tech companies. Initially, Circle's founders aimed to harness Bitcoin to become the backbone of a new digital payment system, albeit one that was centralized rather than decentralized. Circle, along with the likes of Coinbase and Digital Currency Group, even attempted to push major changes to Bitcoin's code. This was done through something known as the New York Agreement in 2017, which essentially aimed to increase Bitcoin's block size. When that initiative failed, Circle quickly pivoted towards Ethereum. And this led to the creation of a new stablecoin, USD Coin or USDC, in 2018. Now, USDC was developed jointly with Coinbase through the Center Consortium, an organization formed to set regulatory and operational standards for stablecoins. And for years, Coinbase and Circle shared both governance responsibilities and the profits from USDC's enormous reserve income. But more on that later. Now, Circle's IPO ambitions first surfaced in 2021 when it attempted to list via a special purpose acquisition company, or SPAC. The timing seemed perfect. Coinbase had successfully listed that very same year, and crypto was enjoying a bull run. However, Circle's SPAC deal faced relentless delays due to regulatory roadblocks from the then hostile SEC, and eventually collapsed altogether following the market chaos triggered by FTX's downfall in late 2022. But that wasn't the end of Circle's IPO journey. After filing a confidential registration with the SEC in January 2024, Circle made headlines again on the 1st of April 2025 when it formally announced plans to list its stock under the ticker CRCL on the New York Stock Exchange. This IPO drew massive attention from institutional heavyweights such as BlackRock, which aimed to scoop up about 10% of the offering. Interestingly, BlackRock also manages Circle's cash reserves. Probably nothing. And Cathie Wood's ARK Invest was also planning to invest $150 million into the company. Now, initially, Circle intended to offer 24 million shares at a price between $24 and $26 each. But due to overwhelming investor demand, Circle bumped this up significantly, eventually selling 34 million shares at an elevated IPO price of $31 each, raising an impressive $1.1 billion. The excitement reached its peak on the 5th of June 2025, CRCL's stock market debut. Investors watched in disbelief as shares surged over 300%, hitting an intraday high of over $100. In fact, trading volatility became so extreme that trading of CRCL was repeatedly halted throughout the day, with it eventually closing at a still staggering $82 per share. At the time of shooting, Circle's stock sits comfortably above $150 per share, giving the stablecoin issuer a market cap of over $36 billion and making it one of the largest crypto stocks out there. Now, following such an explosive IPO, investors are naturally left scratching their heads. Does Circle really deserve these astronomical valuations based on fundamentals, or is it merely another crypto stock caught up in a speculative mania? Well, to answer this, we need to take a closer look at Circle's financial fundamentals. But before we do, if you're enjoying this video so far, then be sure to smash that like button to help give it a boost. And if you haven't already, subscribe to the channel and ping that notification bell so you won't miss our next upload. First up, let's talk about revenue. Circle operates a float-driven revenue model, meaning nearly all its earnings, around 98% to be precise, come directly from interest earned on the billions of dollars held as reserves backing its USDC stablecoin, mainly short-term US government bonds. According to Circle's recent IPO filings, the company generated approximately $1.68 billion in revenue for 2024. And notably, that's a solid 16% increase from its 2023 revenue of $1.45 billion. Recent figures from early 2025 also suggest Circle is on track for an annualized revenue run rate of roughly $2.3 billion this year. In fact, Circle's first quarter revenue this year grew an impressive 58% compared to the same period in 2024, placing it among the fastest growing fintech companies in existence. But here's the catch. Impressive revenue growth doesn't automatically translate into impressive profits. Digging deeper, Circle's operating income, the profit it earns from day-to-day operations after covering salaries, overheads, and other expenses, was just $167 million in 2024. That's only about 10% of its total revenue, which is a pretty thin profitability margin to say the least. And to make matters worse, Circle's adjusted EBITDA, a measure of core profitability before things like taxes and accounting charges, stood at just $284 million for 2024. That might sound decent at first glance, but it underscores how much Circle's margins are squeezed after operational costs. And here's where things get even trickier. You see, after Coinbase exited from its joint venture with Circle, the Center Consortium, in 2022, a new agreement between the two companies was struck. Under this new arrangement, Coinbase directly receives roughly 50% of the revenue generated from Circle's stablecoin reserves. In 2024 alone, Circle had to pay Coinbase a staggering $908 million, more than half of Circle's overall revenue. This arrangement poses a major problem for Circle. Even though its overall revenue grew significantly, these hefty payments to Coinbase actually caused Circle's profits to shrink. And speaking of which, Circle's IPO filings revealed another serious red flag. The company reported a substantial net loss of $769 million during the 2022 bear market. This suggests that Circle's finances are extremely sensitive to crypto market cycles and raises the likelihood it could again lose significant sums if, or rather when, stablecoin demand declines in the next bear market. And Circle's profits are also highly sensitive to interest rates. Remember, Circle earns interest on the enormous reserves backing USDC. Analysts have estimated that for every 0.25% drop in interest rates, Circle's annual EBITDA could fall by roughly $100 million. To offset this drop, USDC adoption and supply would have to grow by at least 10%, which is a pretty tall order, particularly if crypto markets turn choppy again, or if Circle encounters fierce competition from other stablecoin issuers. But again, more on that in a bit. And finally, let's not forget about Circle's sky-high valuation. The company's IPO initially valued it at around $6.9 billion, pricing shares at $31 each. But after soaring close to 500%, Circle now commands a market cap of roughly $36 billion. According to some analysts, that's over 100 times earnings. That means investors are paying over $100 for every single dollar of profit that Circle actually earns, a massive premium when you consider the median fintech company trades closer to just 31 times earnings. So, clearly, Circle's valuation is currently driven more by speculation than fundamentals. And this raises an important question. What exactly are investors betting on here? Well, it could have something to do with Circle's ambitious growth plans. So, let's take a closer look at them. Before we do though, if you're thinking of trading crypto to capitalize on all these market moves, then you absolutely have to check out the Coin Bureau deals page. Over there, you'll find sign-up bonuses of up to $100,000, trading fee discounts as high as 50%, and even deposit cashback offers of up to 75% at some of the best crypto exchanges out there. These offers won't last forever, so click the link in the description below to take advantage of them ASAP. Thank me later. Okay, when examining Circle's growth plans, let's first look at blockchain expansion. Circle's USDC currently operates across 22 blockchains and counting. Most recently, USDC launched natively on the XRP ledger and WorldCoin's WorldChain. Now, launching USDC on XRP is quite significant when you consider that Ripple recently introduced its own stablecoin, RLUSD, presumably as a mechanism for borrowing against its vast XRP treasury without having to sell its holdings. But, well, that's a rabbit hole for another time. Both these recent deployments, though, are possible thanks to Circle's Cross-Chain Transfer Protocol, or CCTP. For anyone unfamiliar, CCTP is essentially Circle's technology that allows USDC to be transferred instantly across different blockchains, making cross-chain transactions nearly frictionless. With the upgraded CCTP version 2, these transactions now settle even faster, boosting USDC's liquidity and ease of use significantly, both crucial for adoption. Meanwhile, another major recent move is Circle's partnership with Brazilian fintech firm Matera, enabling Brazilian banks to directly integrate USDC into their banking and payment systems. This effectively places Circle within traditional financial infrastructure in Brazil, putting it in an ideal spot to capitalize on future growth in digital payments. And speaking of payments, if you watched our recent video on PayFi, you'll know that stablecoins are perfectly positioned to revolutionize payment infrastructure once sector-specific regulations come into force. Given that Circle's IPO filing revealed financial backing and underwriting support from Wall Street giants like JP Morgan and Citibank, Circle appears well prepared to leverage these connections to expand USDC's use in the payment sector. If stablecoin regulations are clarified soon, as many expect, this could significantly increase adoption and institutional investment in the likes of USDC. But Circle's ambitions extend even further. In January 2025, Circle acquired Hashnote, issuer of US Yield Coin, or USYC, one of the largest tokenized real-world asset funds on the market. Circle explicitly stated that the goal behind this acquisition is positioning USYC as the preferred yield-bearing collateral across crypto exchanges, prime brokers, and institutional custodians. And Circle also recently introduced another lesser-known but significant service, Circle Mint. This allows exchanges and institutional players to mint large volumes of USDC without paying any transaction fees, potentially making USDC a convenient and cost-effective solution for institutions looking to move large amounts of US dollars digitally. Meanwhile, Circle is expanding its stablecoin suite internationally, launching EURC, a euro-backed stablecoin compliant with Europe's MiCA regulations. Now, although EURC remains minuscule in volume when compared with USDC, it's one of the first regulated stablecoins in the Eurozone, which actually poses some hidden risks, but more on them later. And let's not forget regulatory tailwinds. Both the US Senate and House are actively pushing forward with stablecoin legislation, the Genius Act and the Stable Act respectively, which could soon provide the regulatory clarity Circle needs to unlock even more institutional investment and usage. So, taken together, these factors indicate a promising path ahead for Circle, on paper at least. However, as you might expect, significant challenges remain, and Circle's current market position is anything but guaranteed. So, let's take a look at these challenges that Circle faces. First, there's competition. Now, so far, Circle has held a strong position in the stablecoin space. USDC is second only to Tether's USDT in terms of market cap. But traditional financial institutions have been watching carefully from the sidelines, and they're gearing up to enter the market as soon as regulations become clear. Giants like JP Morgan have already experimented with private stablecoins, and other major institutions like Bank of America and Fidelity are actively working on launching their own stablecoins too. And let's not forget PayPal, which aims to onboard 20 million merchants to its PYUSD stablecoin by year end. These aren't lightweight competitors. They're financial titans with massive global trust, established brand recognition, and virtually unlimited financial firepower. Circle also faces significant challenges from Tether, whose USDT remains dominant internationally, boasting over $150 billion in circulation compared to roughly $60 billion for USDC. Now, while USDT is primarily used for leverage trading and pooled against altcoins on centralized exchanges, Circle's USDC has traditionally been used in DeFi, making its growth heavily reliant on DeFi activity rebounding substantially. Even more concerning, though, is Circle's decision to comply with Europe's MiCA regulations, something its largest rival, Tether, deliberately avoided. This compliance requires euro-backed stablecoins, like Circle's EURC, to be primarily backed by European government debt. Unfortunately, these European bonds are significantly less liquid and stable than US Treasuries, which presents a major risk. Imagine a scenario where inflation resurfaces in Europe, forcing interest rates higher and bond prices lower. If Circle faces large redemptions of its EURC stablecoin under these conditions, it might struggle to sell these EU bonds quickly without incurring heavy losses, potentially causing EURC to depeg. And then there's Coinbase, Circle's longtime partner and original co-founder of USDC through the Center Consortium. As mentioned earlier, following Coinbase's exit from the consortium in 2022, Circle now shares roughly 50% of its stablecoin reserve revenues with the exchange under a new deal. But recent moves suggest Coinbase might be considering a future without Circle, with the exchange recently investing in an independent Canadian stablecoin issuer. If Coinbase ultimately launches its own stablecoin, Circle could lose a critical demand driver, since USDC effectively serves as Coinbase's main exchange stablecoin. On the bright side, however, a Coinbase exit would free Circle from the costly revenue sharing agreement, significantly improving Circle's profitability. But here's the catch. As mentioned earlier, Circle actually lost a substantial amount of money during the last crypto bear market as stablecoin demand dropped sharply. Without Coinbase's support, Circle could be financially exposed in a similar downturn. And, speaking of bear markets, we need to acknowledge the cyclical nature of crypto itself. USDC's primary use case remains speculation in DeFi. In bear markets, stablecoin demand naturally declines, directly hurting Circle's revenue. If traditional finance competitors strategically launch their stablecoins precisely when crypto activity is lowest, then Circle could lose market share at the worst possible time. And with these stablecoins being backed by megabanks, they could effectively be seen as too big to fail, something Circle certainly can't claim, even with BlackRock's backing. So, while Circle currently benefits from being seen as the most regulated and perhaps most trusted stablecoin issuer, that narrative could quickly unravel when traditional finance giants step in with their own stablecoins. Alright, so after everything we've covered, there's really only one question left to answer. Is Circle's stock actually worth your hard-earned money? Well, on the positive side, Circle clearly has serious momentum. Its recent revenue growth has been undeniably impressive, and its position as one of the most regulated stablecoin issuers certainly gives it an advantage over many of its competitors. However, this brings us to a critical question. What exactly is Circle's endgame? Well, we think the company's ultimate goal could be to position USDC as a so-called synthetic CBDC, or central bank digital currency, something Circle's CEO Jeremy Allaire has openly discussed. As the name suggests, synthetic CBDCs involve a partnership between a private company, in this case Circle, and a central bank, like for instance the Federal Reserve, to issue what amounts to a de facto central bank digital currency. Jeremy has said that USDC's reserves could one day be held directly at the Fed, which would mean shifting reserves away from traditional US bonds towards direct central bank liabilities, or facilities like the Fed's overnight reverse repo, where yields can be earned without price risk. If this scenario plays out, Circle would effectively be issuing a digital dollar indistinguishable from an actual CBDC. Given that centralized stablecoins already have built-in programmability, like the ability to freeze funds, for instance, this somewhat dystopian scenario seems far more plausible than perhaps many realize. Now, President Trump has explicitly rejected the idea of a US CBDC. However, the same isn't true for Europe, and this might explain why Circle decided to take on the risks associated with complying with Europe's MiCA regulations, potentially aiming to position EURC as a synthetic CBDC in the European Union. Now, clearly, this path would stray very, very far from crypto's decentralized ethos. But considering the intense competition that Circle will soon face from financial giants like JP Morgan and PayPal, well, positioning itself as a synthetic CBDC issuer might actually be its best, or perhaps only, way of surviving and maintaining market share in the coming years. But what does all of this mean for Circle's stock? Well, considering that CRCL is already trading at over 100 times earnings, it's hard to deny that it's significantly overvalued at its current levels. Moreover, as we've mentioned, Circle historically suffered significant losses during crypto bear markets due to falling stablecoin demand. This means Circle's stock could plummet along with the broader crypto market once speculative demand inevitably dries up, making it a particularly risky hold when the next bear market rolls around. It almost seems, though, as if Circle is strategically building itself a financial runway to weather the next bear market. Now, if you watched our recent video on the crypto IPO boom, you'll know that there's a long queue of crypto companies waiting to go public after Circle. Logic would suggest these companies believe the current bull run still has plenty of gas left in the tank, and they want to time their IPOs close to the mania phase of this cycle. So, while Circle's CRCL stock could rise further from current levels alongside the broader crypto market, we wouldn't expect the kind of crazy returns we've seen up to now. In fact, you might even be better off waiting for some of those other upcoming crypto IPOs. Not financial advice, of course. All that said, though, if Circle successfully survives the next bear market and overcomes the challenges that we've discussed today, then CRCL could actually become a compelling stock to pick up during the next downturn. But let's just hope this crypto bull run still has some way to go for the sake of our altcoin bags and our sanity. And that's all for today's video, folks. But if you want to see our top 5 stock picks for crypto exposure, then check out our dedicated video on them right over here. Thank you all so much for watching, and I'll see you again very soon. This is Guy, signing off.